When I first started making money, I still remember the very first investment I made was in a mutual fund. So it's the most sensible sort of an investment that any first-time investor can make is to invest in a mutual fund. And in this video, we are going to look at what are mutual funds, how they work, what are the types of mutual funds, how to select a mutual fund for yourself for your first time investing, and then we'll go about reading a mutual fund page and what all are the details that are associated with a mutual fund and how to go about evaluating a mutual fund. And then I'll be going and doing a live investing in this video in a specific mutual fund, and I'll also explain how I go about investing in that particular mutual fund. So firstly, let me explain what mutual funds are. Right, mutual fund is a fund. It's very pretty straightforward. It's a fund where there are a lot of small investors who are actually pooling in capital, which could be few hundreds of crores or actually thousands of crores. And there is a manager who is a mutual fund manager who takes this specific pooled fund to basically make investments based on the theme of the mutual fund. There are different types of mutual fund which we'll be looking into. So he'll be basically taking this mutual fund which is basically pooled by the investors, where the investors are coming with a specific mindset, and when they choose a specific type of mutual fund, they're coming with a specific risk and a specific actually type of return and investment that the mutual fund manager will understand these things and basically make the right investments for them, right? Why this is very important for the first time investors is like you don't need to basically think a lot about which stock to pick and stuff like that. Mostly all of the mutual fund managers are very professional folks who have been doing it for a very long time. When we talk about the types of mutual funds, as you can see here, the different kinds of mutual funds. One is the debt fund and the equity fund. These are the two major types of major categories of mutual funds that are there, debt and equity. So when we are talking about debt, it's more about like it could be corporate debt, it could be government debt. You don't need to go into the nitty-gritties when you're making your first investment. So all you need to know here is like debt is a very stable, very predictable sort of a investment. So it's not like in one day basically debt mutual fund will give you -1%, -2% return. Debt funds are always like slow compounders, and they have like anywhere between 4 to 6% or sometimes 8% of return. On a high level, debt mutual fund is a low risk mutual fund, and in debt also you have like ultra short term debt, medium term debt, long term debt, and different kinds of debt mutual funds. When we look at equity mutual funds, it's more about the mutual fund manager is gonna invest this pool of capital in stocks. And in equity mutual funds, you have different kinds of things where it could be a sectorial fund where the investment is going in specifically in IT sector or specifically in pharma sector, and the mutual fund manager is going to select top companies in a specific sector, right? This is the first kind of mutual fund. The second kind of mutual fund is more like large cap, mid cap, small cap, right? This is more like understanding the quantum of the market capitalization that a company has. Market capitalization, what I mean is like the value of the total stocks in the market is known as the market capitalization. If you look for HDFC Bank, it is somewhere around 3 to 4 lakh crores and something like that. So based on this market capitalization, stocks are categorized into small cap, mid cap, and large cap. So large cap is the lowest risk stocks, mid cap is like moderate risk stocks, and small cap is like less than 10,000 crores of market capitalization, which are highly volatile and risky. So you can go about investing in small cap, mid cap, large cap sort of a setup. Or the final thing, which is the most widely used mutual fund by a lot of salaried folks and things like that, is index fund. Index fund is more like it tracks a specific index. Index could be like technology index, banking index, Nifty index for that matter. Nifty index is the top 50 stocks in the Indian stock market. So there are a lot of different kinds of indexes, and mutual funds even track these indexes. So as you can see here, Navi Nifty 50 is a index fund. So let's go about going through all of these different things that are present on this page of the mutual funds. As you can see, it's written like it's an index fund. It's a very high risk because it's an equity fund, and it has given this much of return in last 6 months or 1 year. Actually, this mutual fund got launched during the 2021 time, and the markets are down since then. So there's nothing wrong as such, because this tracks the index directly, which means how much ever Nifty 50 is returning, this very similar sort of a return is what you'll get through this index fund as well. So I've priorly invested a little, so let me explain one more thing here. So every mutual fund, whenever you invest, you get a certain units based on the AUM of the fund. AUM of the fund is like assets under management. So if you see here, the total fund size is 366.87 crores. So now what these people do is like whenever a new person investing say 1 lakh rupees, new units are created and basically given to the new investor. These units in turn actually are tracked through this NAV value. So this NAV value, whenever the mutual fund starts a new fund offering, which is known as NFO. This is very similar to an IPO for stocks. A similar sort of a launch mechanism for mutual funds is NFO. So when a mutual fund does a new fund offering, the NAV starts from 10 rupees, right? And if you buy at the NFO, you will get 1 unit for 10 rupees. And as the mutual fund actually does better, as more and more people invest in this specific mutual fund, the NAV slowly increases, and your units also appreciate. So all you need to know and take away from here is like whenever you make an investment, you get units, and the value of each unit is its NAV, right, which changes every day, and the value reflects here. And one more concept here that you need to understand is the concept of SIP and one-time orders. So if you see on the top here as well, you will see a monthly SIP and a one-time order. So monthly SIP is more SIP stands for systematic investment plan, right? So now what happens is like, say if you're a salaried person, you get your salary in the first week of every month. So a lot of people, what they do is like they don't care about what the market actually condition is. All they want is like 5,000 I'll invest in this mutual fund, 5,000 in this, 5,000 in this, and they have an allocation. So they want us to follow the same allocation every single month. Instead of manually you going and placing one-time orders, what you can do is like you can go to the monthly SIP and you can say I want to invest 5,000 every single month on say like 6th of every single month. And if you start this SIP will get triggered, and on every 6th of every month basically the amount gets invested in the specific mutual fund. So this is how this SIP works. A lot of people use SIP because it's systematic. At the same time, you have the consistency in the market, which increases the chances of you growing your money in the long term, right? So that's how this is seen. So this is an SBI index, Nifty index direct plan growth. This is an index fund, as you can see here. So if you go here, there's a rating for every fund based on the performance, how well they are beating the other similar sort of index funds in the market. The higher the rating, the better. And these are all the things that we have already discussed about. So if you see here, if you say invest like 25,000 like we did priorly for 5 years, so you would have made like made total investment of 15 lakhs in 5 years if you invested 25,000 a month. and you would have made like 30% return on this in the last 5 years. So this is how you calculate through this simple calculator that you get on this page. And then you see the peer comparison, and after that what happens is like you see a holdings. So this holdings is a weighted percentage. Say if Reliance is the number one stock in Nifty 50, then its market cap is taken, let's say it is X, and the total market cap of all the other Nifty 50 stocks along with Reliance are in the denominator. So you get that Reliance is actually 12.8% of the Nifty index fund. So the index fund basically picks up 12.8% of Reliance Industries for every investment that you make. Which means if you invest 100 rupees, 12.8 rupees goes into Reliance, 8 rupees goes into HDFC, 7.7 in Infosys, and so on and so on. So whenever you make a new investment, it is proportionately invested in the different holdings that the mutual fund has, right? And you can see different kinds of sector allocations, what are the different kinds of stocks which consists in this specific mutual fund. And you have some PE ratio, PB ratio, which I don't think you would need as a first time investor, right? You will see some like the one very big important thing is like the expense ratio and exit load. Expense ratio is like, say if there is a mutual fund house and a mutual fund manager from the mutual fund house managing your money through a mutual fund, then they will take a specific actually percentage of your invested capital as a management fee. So every year they are charging 0.18% to manage your money, and this gets directly deducted from the returns that you make, and the NAV that you see is after the expense ratio. So basically this is the amount that you're paying to the mutual fund house and the mutual fund manager for them to manage your money. This is like the fee that you pay, right? The second thing, what is an exit load? This is a very important thing. Say if you put in your money in a mutual fund and you want it like after 5 days, let's assume. So the mutual fund house generally has an exit load. For equity mutual funds, exit loads could be like, if it is a growth fund, it could be like 1 year tak it's 1% or things like that, and after 2 years it's like 0% exit load. As presently we are talking about index funds have a lower sort of a exit load, which you can see is like 0.20% if redeemed within 15 days. So if you redeem within 15 days, 0.2% is what you pay. If you redeem on the 16th day, you don't pay any exit load, right? And then the tax thing, you would understand, it's a pretty self-explanatory thing. There are short-term and long-term capital gains. I'll make a separate video sometime in the future. And then you can see the fund manager and read about what all are the mutual funds that this fund manager is managing. Seems like he's a pretty qualified and pretty experienced mutual fund manager. You can see his qualifications, experience and stuff like that. And then you can see the other plans, you can compare funds and things like that. This is how you read a mutual fund page, right? So now I hope you understand the different types of mutual funds. We have seen there's debt funds, there's equity funds. In debt funds, it's more like you get a fixed return. It's based on the interest rates. It could be corporate debt, it could be government debt, which is less lucrative, but they are very stable. As a first time mutual fund investor, I would not suggest you go with debt funds. Debt funds are more like to park your wealth. Say if you want an emergency fund which you want in the next 6 months, then you go about investing in a debt fund. Whenever you invest in the equity fund, you should go with a minimum time frame of 5 years, because you don't know. The market has been down since 2021, mid of 2021, late 2021, and it has been like 6 months, 8 months since it has been down. So if you invest in an equity mutual fund today and in 3 months, if the market is further going down and you want the money, so you won't be able to like even if you are able to get back your money, you will lose a lot of your capital if there's a market actually turned down. So it's the best thing to do is like, if you want the money in like within 2 years, go with debt funds. If you want to park it for very long term and you don't have anything to do with that money and you want to park it for the next 3, 4, 5 years and grow it in a compounding manner, then you should go about with the equity mutual fund, right? So I hope you understand, now you understand what are mutual funds, how do they work, what are the different kinds of mutual fund, how to read a mutual fund page and the different terms in the mutual fund page, right? So now what I'm going to do is like, I'm going to do a live investing in front of you. So this is the mutual fund that I've been tracking for quite some time, and I've been investing in this because the index fund is going down and down. Sometime in the future, this is gonna rebound once economy gets back on track. So I've been tracking this mutual fund, and this mutual fund has the lowest expense ratio in the index funds. As I've told you, we saw in SBI mutual fund it was 0.20%, but Navi mutual fund has 0.06% expense ratio, which is the lowest in the market. So without further ado, let's just say one time I wanna invest like 25k, and all you need to do on Grow, I'll also leave a link to Grow. It's a very user-friendly platform for any first-time investor to invest in any sort of assets. It has stocks, mutual funds, which you can invest in. So I've selected one time, I've selected the amount that I want to invest, and I just invest, right? I'll explain the process of how this thing happens. Now, they say that order is placed and the fund name is this, the amount is this, and there's a status. So what happens is like, firstly, when I place my order is sent to the mutual fund house. Here Balaji has invested 25,000 rupees in this mutual fund and he wants his units, right? After 2 to 3 days, what happens is like they allot some sort of folio number along with my units, and they basically give it to the Grow or any demat broker which will be showing my order status. And then once I get that units allotted in my demat, the order gets completed and the status gets completed, and my orders will be shown in my orders. I mean, you can go to investments and you will be able to see these mutual funds that you have bought in this page, right? So this is one in progress order, and you will see all the other mutual funds here. This is one of my account where I make my investments. There are a couple of more, but I basically invest in mutual funds through this account. So this is how you invest in a mutual fund. I've shown you live investing in a mutual fund, and that's it. I think that's it for this video. I really hope you have learned something out of this video, and I'm really happy for you in case you have watched this video till here. You're one of those people who support and motivate me in creating more such videos, and I really thank you from bottom of my heart, and have a good day. I'll be making more such videos, and in case you have any suggestions for any sort of videos, do drop them in the comment section. And if you like this video, do share it with your friends, colleagues, or anyone who are looking to make their first investment in mutual funds or any kinds of assets. Let them understand what mutual funds are before they make any other investments, and learn about everything that you have learned through this video. And that's it from my side, and I will see you in the next one.